Welcome to Key Tech. Please describe this channel if you are interested in today's video. In the current world economy, the US dollar is leading a new round of currency wars and exchange rate wars. The Japanese yen has been crazily suppressed and harvested. The exchange rate of the US dollar against the Japanese yen has hit a 34-year high. Even the IMF predicts that Japan's GDP will most likely be overtaken by India next year. The reason is that the Japanese yen exchange rate has plummeted. Obviously, this round of US dollar interest rate hikes has not achieved its goal of harvesting. It is just the beginning to destabilize Japan. The collapse of the Japanese yen exchange rate has spread to the entire Asian currency market, and the risk of triggering a financial crisis continues to rise. You must know that the 1997 Asian financial crisis was triggered by the collapse of the Thai baht exchange rate. However, the country that the US dollar really wants to harvest is not Japan, but China. The country that the US dollar really wants to harvest is the foreign trade export-oriented economy, which has a certain dependence on the US dollar, and China is the world's largest trading country, with an annual trade surplus. It is also the first in the world. Frequent visits by US dignitaries can illustrate the problem. Yellen said that China's new energy industry is severely oversupplied, intending to prevent the development of China's electric vehicle industry and hinder the pace of industrial upgrading. Europe even proposed to impose tariffs on Chinese electric vehicles. At the same time, Yellen hopes that China will continue to buy US debt, but this wish has obviously come to nothing. Not long ago, China reduced its holdings of US debt by more than $20 billion. In addition, the United States cannot unilaterally stop the rapid development of China's electric vehicles. After Yellen, Blinken came again. This time Wall Street said that the United States may impose financial sanctions on China, especially the possibility of cutting off the connection between Chinese banks and the global financial system. This means that the United States is considering kicking China out of SWIFT US dollar settlement system. The United States is planning to exclude China from the SWIFT Interbank financial system. The Wall Street Journal currently believes that this is an attempt by the United States to help Blinken's visit to China to pressure China to stop any commercial support for Russia. In response to this move by the United States, China has actually fought back. Just recently, the Bank of China expressed its support for secondary market bond transactions. Regarding this news, the current mainstream interpretation is that China will no longer use the US dollar as its anchor, but instead use national debt as its anchor. Judging from this alone, it also means that China is preparing to cut off from the US dollar. If this happens, it will naturally have a certain impact on the international economic situation, and it will also be very uncomfortable for the United States. For a long time, the United States has used the international currency attributes of the US dollar to influence and even harvest the global economy through the issuance of US dollars and interest rate adjustments. For example, in 2023, the Federal Reserve will continue to raise interest rates. Judging from the Fed's statement, this is to reduce inflation in the United States, but in reality, this series of actions by the Fed actually caused a lot of funds in the global economic market to flow to the United States. The US dollar also began to rise significantly against other currencies. In order to cope with the rising exchange rate of the US dollar and the falling exchange rate of local currencies, many countries, including the European Union and the United Kingdom, have actually begun to raise interest rates along with the United States. However, judging from the current situation, this series of measures has not achieved much results. As the world's largest exporter of goods, China is also a major trading partner of many countries. If China is really removed from the SWIFT system, it means that many countries will also leave. In fact, before Blinken's visit to China, the United States released a lot of signals and started from many aspects, hoping to increase Blinken's bargaining chip with China this time, and to get China to agree to the United States' request to give up commercial support with Russia. However, it is obvious that after China's counterattack, Blinken's bargaining chip is actually much less. At the very least, the bargaining chip of excluding China from the SWIFT system is basically impossible to use. In addition to announcing support for secondary market bond trading, China also recently test-fired Julang 2, which is actually a statement and counterattack. There is no doubt that the global economic market is becoming increasingly turbulent ahead of a series of stirring actions by the United States. The recent sharp depreciation of the yen has been considered by many industry insiders to be a global economic crisis, a manifestation of normalization. But it is obvious that the United States has always focused on its own interests, and it is not surprising to do such a thing. It can also be seen from the current Russia-Ukraine incident and the United States' hope that China will give up commercial support for Russia in any situation, that the United States actually wants to make money. After all, according to reports from Ukraine, many of Russia's weapons systems are shipped from the United States. In a sense, the United States actually wants to make money from both sides in this Russia-Ukraine incident, but it does not want China to participate. This also makes the purpose of the United States very clear. As for whether Blinken's visit to China can achieve its current goal, there is currently no accurate news, and the result is difficult to guess, but there is a high probability that there is no way out. If you agree, please like it, welcome to repost, leave a message and share it.